We continue with our final discussion on Ultratech Siemens, and there are two or three things that we need to now close. We already had put in some sort of a calculation around the FCFF here, and we have to find the beta of the firm to be able to close it correctly. The second thing that we're going to do is we want to incorporate the impact of the acquisition of the Jayaprakash cement plants, which will take up the capacity to FY18 by about 20 million tons, right? So that's basically what we want to do, and then see what impact happens. So let's first incorporate the acquisition bit. Now, JP is selling roughly 22 million tons per annum plants to Ultratech for about rupees 16,200 crore enterprise value. That's the news, right? So if we read this here, we will see that approximately 16,500, 16,200 is the exact number, and roughly about 22 million tons is what is getting added, and that's the broader deal that's happening here. Now, within this deal, there is roughly about 12,000 crore that's going to be as debt. So, if you see this, under the proposed deal, Ultratech will acquire debt of about 13,500 and 3,000 crore in cash, right? Now, this news changes a little bit here or there, and we will see that roughly about approximately 12,000 odd crore is the debt in some of the other news items that we see. And so what's happening is, if you look at the balance sheet, there are assets worth 16,000 crore getting added. Cash and current investments will go down by 4,000 crore, but your long-term borrowings will go up by 12, right? So what's basically happening is, if I were to put this here, your debt is going up by about 12,000 crore, assets are going up by about 16,000 crore, and cash is going down by 4,000 crore. So approximately this is what is happening, and those are the changes we need to incorporate. And obviously, because of this, the capacity will go up to a certain number. So what we're going to do is, in FY 18 is where we are going to kind of add this. So in the balance sheet, I'm going to basically go ahead and approximately increase the debt by 12,000 crore. Approximately, right? What that will do is the balance sheet will not balance, obviously. I'm going to reduce the cash by about 4,000 crore, right? And I'm going to increase the assets by about 16,000 crore. And it'll be better if we do the assets increase on the capex and debt schedule. And we add in FY18 roughly about gross fixed assets of 16,000 crore. Right, so what that does is, if we go to the balance sheet, we see that the balance sheet balances. This 12,000 crore doesn't match, because ideally we should be doing the debt thing also in the debt schedule. So we go to the debt schedule and we say long-term borrowings are going to be this plus new debt raised, and new debt raised, let's just put 12,000 crore here, right? So what that does is adds 12,000 crore there, and that obviously changes it here, because on the cash flow it'll start assuming that the 12,000 crore came here. Here there's no cash inflow happening because of that debt, right? That debt is just coming on the books. I'm going to remove this 12,000 crore from here. Once we do that, it automatically goes and balances the balance sheet, right? So we did 2-3 things. We went to the capex and debt schedule, added 16,000 crore here, right? Then we went ahead and added 12,000 crore to the debt here. And then we removed this 12,000 crore from the cash flow because there wasn't any cash flow happening. And we cut down the cash balances in 2018 by approximately this. This becomes negative. So what I'm going to do is I'm going to cut this by 2,000 crore and I'm going to cut this by 2,000 crore. Right, so my current investment goes down to 28 crore. It stays there at 28 crore. Cash goes down by this amount. That's the impact. Now what that does is on the balance sheet here, you change the capacity by 24 million tons. So it becomes about 93 million tons, right? Once it becomes 93 million tons, automatically the P&L incorporates the changes, and this move changes things. So you will see the cash flow, it becomes negative in this year because of the fact that there is a big capex sort of thing that's coming in, and then you kind of move in and make those changes that make your cash become negative here. The cash flow turns negative because of a small issue here is that we have assumed that this is new capacity and they're doing a cash flow for that. Now that's not happening actually, right? That's only 3 million tons here. So I'm going to put this back uh, at the assumptions at 6. So this is going to be 72.3, and capex doesn't happen because of this. So here the new capacity excludes that amount, right? So my balance sheet stays here and we see the cash flow impact, and now the cash flows actually increase. That's obviously because the company is making money, right? Does the balance sheet stay balanced? It does, right? So that's the nature of this deal. Debt goes up, which will mean that interest cost will go up for the company. So finance cost increases dramatically. Your depreciation increases, but at the same time, you're not really going ahead and doing a cash outflow because of this. And hence what happens is the cash flow actually increases. The second bit we need to do is calculate the beta of Ultratech. So we could go and either download the Ultratech data, and let's do that. Ultratech Cement Limited, we will go and look at historical data, and we need more than 3 months data. Enter the symbol Ultratech, last 365 days, get data. Right, so we get this data for 365 days. Let's download this file. Open this file. So we get the data 4th of April onwards. Let's look at the closing price. That's all we need. And we can delete all this, not needed. Right, we can delete all this as well and put Ultratech here. Right, now I need the Nifty values. So we can go to the Nifty, we can go to products, indices, historical data, price volume data. Let's search Nifty for 2016. Let's take this from 4th of April till 3rd of April 2017. Get data, download in a CSV format. We are looking at the closing price only. So we pull that out, put it here. Let's check that the data is equivalent in terms of dates. It is. Let's format this. Let's find the returns. So the return is today minus yesterday divided by yesterday. Same here. Double click, convert it to percentages, and then all we need to do is find slope of this, where the known y is Ultratech return and the known x is the stock return, and we get 1.17 as the beta. 1.17 as the beta, or 1.18 as the beta. So in our model, we just go and replace it by 1.18. So obviously cost of equity jumps up, WACC changes. Now, another thing that happens is market value of debt has to basically incorporate the 12,000 crore. So what I'm going to do is I'm going to link the debt to the balance sheet instead now, which will be this plus this. So that's the debt, and that gives me the WACC that comes out. Let's make an assumption for terminal growth rate. Terminal growth rate, let's say, is going to be 4%. Usually these companies grow roughly about 1.5, 1.2 times the GDP. So if our GDP real growth rate in the long run, or nominal growth rate in the long run, is expected to be slightly higher, obviously this cannot be higher than the GDP, but somewhere around 4 to 5% is what we're going to expect as the terminal growth rate for this kind of a company. Now, you see cash flows falling. That's also unlikely to happen. So one more thing that we need to do is incorporate the fact that utilizations will go up. For that, we will go to this presentation that they had given in May 2016 and first put in the data for Indian markets. So FY18 is given 1920, right? This is what we are going to kind of put in our data. So we're going to go here on the assumption sheet, and 18 we have put in. Let's put in what's going to be the capacity, 436, 436. So we're going to put in 436 and 436. And let's assume a minor increase in the next year. That's going to be, let's say, 450. And the demand numbers that we see here as per projected by the company are 330, 356, right? So this is 330. This is 356, approximately a 7 to 8% increase every year. So I'm going to increase this by another 8% in the last year. What's the capacity utilization industry-wide that we see? So capacity utilization actually goes to 85% in the final year, right? It goes to 85% in the final year. And because it goes to 85% for the industry, the assumptions that we have taken are actually quite conservative. This probably is going to go up to 90% or so for Ultratech Cement, right? Ultratech Cement has had a 5% kind of a gap every year. So here I'm going to put about 5%, and here I'm going to put about another 5%. Approximately 90% capacity utilization by the end of 2021 is what's going to happen, right? Otherwise, it may not make sense for them to add up all this capacity. So 90% capacity utilization is what we see. Obviously, when capacity utilization will go to that level, the prices will start improving. So I'm going to start with a gradual increase and then assume a 5% increase in 2 of the years and keep it constant for the last year. Similarly, what will happen is some of the other things might stabilize a bit. Now, what we need to check is what happens to the operating margins, right? So let's just quickly insert a row here and check what happens to profit before exceptional item. Let's calculate it right from here and divide it by the revenue from operations and convert this bit to percentages. And let's see what's happening here all the way till the end. So the number used to be 25%. It goes up to about 28, 27%. That's possibly a little bit steep. It may not go up there. 25 is where we are going to kind of stabilize it, because historically that's been the level. So maybe these freight changes stop going down and they become 0% in each of the years. And similarly, freight and power and fuel, they become 0% in each of the years. So what does that do to the P&L? Let's see. Yeah, now the operating margins kind of stabilize around that level. We're going to keep these around these levels, right? So effectively what we are saying is that margins will stay constant if they are able to increase the cost, if the costs go up, they will be able to increase the prices as well. And that would give us the final values for the cash flows. We do get a certain set of cash flows. There's a small decline here, but that's okay. That's because we are assuming that that this is going to go down. Terminal growth rate is calculated, WACC is calculated. What we can do is calculate the terminal value. So that's going to be this into 1 plus the terminal growth rate, which is 5%, divided by WACC minus 5%. And that's what we get, correct? And now because FY17 is gone, we're going to basically start the discounting from FY18 onwards and try and find the value by discounting the FY18 numbers first, and then see what values we get here. So now this is approximately 1 year away. So years to cash flow, 1 year, 2 year, 3 years, 4 years, and the final one will be 4 year. So PV of FCFF is what we are going to find out. That's going to be this divided by 1 plus the cost of capital frozen raised to the power 1, correct? And we close the bracket. That's the value we get. Let's just drag it on the right side, right? So we get these values here, and that's, remember, the firm value that we are getting in terms of data. Now, one of the things that we need to be careful is that while this goes down, what this does is this lower number impacts the entire terminal value as well. So we have to be a little bit careful with this kind of a calculation, that the last year value does not decline too much. I mean, if we were to calculate the growth rates in FCFF, that's going to be approximately about 30% here, about 24% here. It can't suddenly become negative and then can't be 5% here. So one of the mechanisms we do is, first, this last year number has to be a little bit more sensible. So maybe what happens is the price thing probably increases by a few more percentage points here, and we see what happens to both the P&L in terms of profitability and in terms of the cash flows here. So if I change this, the cash flow goes up significantly. Maybe not this much. Maybe we are going to assume a slightly more sedate kind of a move in pricing. So let's put 2% and see what happens to the cash flow. Becomes about 5%, and we see this kind of a movement happening here. Now, because 3 of the years the price point has been, the movement in cash flows has been about 10% or so. In the last few years, what would happen is you can't suddenly assume a 5% kind of a number. So if the average here is about 20% in these 3 years, then usually a better method is to do something here. We increase this by about another 4 years. Sorry, so let's increase this by another 4 years. And instead of taking terminal value here, we're going to take the terminal value here, and the FCFF is going to get increased a little bit every year. So we're going to assume a certain growth rate of FCFF so that we can taper down this entire thing. So maybe it grows at 10%, then keep declining this number by about a percentage point here, so 9 and then 8 and then 7, and then maybe after this it grows at the terminal growth rate of 5%, right? So that's what we are assuming. So what happens here is this does not remain the terminal growth rate. This becomes this into 1 plus 10%, and then so on and so forth till here, and these become 5, 6, 7, 8, and then the terminal value comes here, which is this into 1 plus the growth rate, that's 5%, divided by 13% minus 5%. And that's my terminal value that comes here. And now I can just drag and discount all of these here, right? This discounting now gives me a certain more set of values over these years, tapers down the growth rate of cash flows to an extent, looks at my profit and loss account and puts my margins at about 25-26%, and gives me the total value of the firm. So total firm value is nothing but the sum of all these present values that we have calculated, right? From this, I have to subtract net debt. So net debt is going to be my long-term debt. That's this minus the cash values that the company has in this year, which is about 4,000 odd crore. That's the cash values that we have, right? And if you want to take the cash at this point of time, then that's FY17, but we are incorporating the changes of the debt here, the cash here. So that's the value we get here. And firm value minus net debt is going to give me the equity value. So that's this minus this. And we find that the market value of equity is about 1,09,000 crore. Equity value we calculate here is lower, so the stock seems overvalued. The stock seems overvalued, and that's the broad idea about our final valuation. This completes our valuation here. Obviously, there are sensitivity changes that change here. So if your beta goes down to 1, for example, the value reaches closer to the market value. So maybe the stock market expects the beta to be lower, or the stock market expects that over a period of time the WACC would be lower, and that would take the market value higher. Maybe the market expects that there's going to be a steady increase in these assets, and they're going to kind of make a lot more money on these newer assets which are going to come in, and consequently the assumptions around some of those things might change. If we were to assume instead of a 5%, a 6% kind of a price increase for 2 years, then profit and loss account would have increased slightly higher, and that extra 1% you will see takes the value up by about 10%. So this valuation is extremely sensitive to what's going to happen to the price of cement in the future. And that's one of the key learnings that we get out of this entire model of Ultratech, right? That's basically where we close our Ultratech model. We've incorporated the earnings, we've incorporated it into a three-stage model: high growth, declining growth, and then terminal growth value, right? That's what we basically get. That's the final calculation that we have. We already know that if you want to change these years, how do you calculate the years to cash flow? That could also be incorporated into this entire thing. And I'll change this again to 1.18, what we have calculated, but the sensitivity basically tells us that the value could be higher. And that's what if the price change in cement is higher, then the value could be higher. But for all practical purposes, this does look a little bit overvalued compared to the market value. What we are getting is about 20-25% lower, right? That's basically the calculation in terms of Ultratech Cement that we wanted to do, and that's the DCF valuation model for Ultratech Cement.